Greetings, everyone. Welcome back to another Portfolio Management Edition. This week, we are talking about investing cash in a bear market. We've done a similar post in the past about investing cash in a runaway market when the market's going up. This is a little bit different spin, but I think the principles overlap. And I've noticed a lot of people, younger people, older people, trying to bottom tick the market, trying to wait until we fall further, or they're trying to time the bottom perfectly. That is a fool's errand. It's impossible. Humans are incapable at predicting or forecasting large inflection points. So this is a more rules-based approach to putting cash to work backed by empirical evidence. So I'm not saying that we can't drop further, but this is what I'm doing. This is what I would be doing. And I hope you get something out of this. So I'm going to share my screen. I'm going to bounce around a little bit. So hopefully I don't butcher this. Okay. So again, the genesis of this post is investing cash in a runaway market. I did this back in 2020, but I think the principles are still pretty good. So my first message is to just do it. Build a portfolio that fits the way you feel about risk. Get 100% invested today. And then go take a walk, go focus on what you like to do in life. Now, this is loaded with probably the most anxiety for people just because you're taking a bucket of cash and investing it all in one fell swoop. And of course, this is dependent upon where you're at in life, your income, your financial plan. So this is a little tongue in cheek, but the gist of it is don't overthink it. Go ahead and plop the money into the market, especially if you have a longer runway. If you have 10, 20, or 30 years until you need the money, don't overthink it. That's the overarching message. And there's always going to be reasons why someone shouldn't invest. So this is a chart that I really like, and I'll blow this up. But this goes back to 1926, growth of $1, and all the things that were happening in the news, all the things people worry about. And this black line, sure, it has some dips in it, but the obvious trend is towards the northeast corner. So this is going up. This is a train that you'd like to be on, okay? So there's no such thing as a all clear signal. There's no sign that says this is the bottom. There's always going to be reasons why you should not invest. Don't overthink it. If you have a long runway, just invest. The second point is dollar cost averaging. Well, let's go back to the first point, getting invested today. So this is a graph that actually really surprised me. So what this is the S&P 500's percentage of the time positive over various time frames. And let's see when I wrote this one. So this was September 2nd, 2021. So still fairly recent, less than a year old. Okay. So how this reads is if I invest all of my money, let's say, into the S&P right now, in 1 month, right here, 1 month, there's a 60% chance that the market's going to be positive. And I say the market, I mean the S&P. Over 1 year, that jumps up to almost 70%. Over 5 years, that's almost 80%. And you can see at 10 years, at 20 years, 88%, 96% of the time, you would have a positive outcome by investing. What surprised me about this was how positive it was over a year, right? Like this number seems pretty high to me, which is a nice surprise. So again, if you invest money today over every period from the last, I think this is since the S&P's inception, going back 30 years, you would have been positive 70% of the time going forward 1 year. That's pretty powerful stuff. So this is, again, the last graph. This graph is supported of just doing it, just getting invested, okay? The second approach is to dollar cost average over time. For those of you that don't know what dollar cost averaging is, it's investing a fixed amount of money over a set period of time. So, if I'm a employee and I'm putting money in my 401k, you might not know it, but you're dollar cost averaging. Okay, maybe you're investing $1,000 a month, and you're doing that every month over multiple years. Sometimes you're buying high, like now. Sometimes you're buying low. Over time, you're averaging in, and it should smooth out your entry point and the ebbs and flows of the market. So a lot of people obsess about their investment approach. It really, successful investing and wealth building really come down to consistency and your savings rate, not so much generating the highest return that you possibly can. It's generating reasonable returns that you can sustain over a long period of time. That's how true wealth is built. Notice that dollar cost averaging has nothing to do with the market is doing. So it's not like if the market is tanking, I stop saving. If the market's going higher, I save more. It's investing a fixed amount of money over a period of time, come hell or high water. And just kind of to piggyback on my invest it all now. And again, I'm not saying you should do this. It depends on your personal situation, but we are in a bear market. Everyone knows we are in a bear market. Historically, when you invest, once we reach that bear market threshold, future returns over the next year, this dark blue line, 3 years, 5 years, and 10 years are higher than non-bear market years. Okay, so when investing when it feels the worst often is rewarded with higher future returns. And this is the S&P after we hit a bear market threshold, which is down 20%. This is all post-World War periods, bear market periods. So roughly, what is that? 70 years of data, almost 68 years of data. Pretty powerful stuff. So you can kind of see where I'm going with this. Strategic approach. So every market, there's leaders, there's laggards. Right now, there's more laggards than leaders. So I'm going to move a PowerPoint picture over here. So I shared this in our June market commentary. And if you want to be a little more strategic, you can see this is the Russell 3000. So this is basically a snapshot of the US stock market. The average stock is down 44% from their 52-week high. Okay, you can see all in this purple bar down. So if you're a stock picker, a lot of active mutual funds, a lot of people, a lot of do-it-yourself investors like to pick stocks. This is the environment for you, okay? If you're interested in a certain sector, if you're interested in a certain narrative or thesis or investment style, this is where you should start to sniff around based on what you're interested in. So a lot of people like big tech. Well, if you liked Amazon when it was trading 40% higher, you probably love it at trading down by 40%. So again, allocating capital based on what you're interested in or what the areas of most pain could provide some value. Lastly, and this is probably I don't want to say it's my favorite approach. It's the approach that I think institutional investors who's managing money on behalf of clients, I think it's the best for those types of investors, where we're investing based on the riskiness of an asset. So let me explain. Let's say their investment objective, their ideal portfolio is 60% stock and 40% bond. I'm starting with 100% cash. A risk-based approach would be a combination of dollar cost averaging. Okay, so let's say I want to get this invested over the course of 30 to 60 days, all right? And targeting assets which are traditionally less risky first, like bonds, or beaten down. So if an asset class is less risky like bonds or an asset class is beaten down, I'm going to be more aggressive allocating capital today. And let's say bonds are down, stocks are down, like it's what's currently happening now. I might get this portfolio fully invested in 30 days. All right. I might start with the most beaten down stocks. So I might start with tech stocks, right? I might start with foreign stocks or emerging market stocks. Those types of markets have been absolutely crushed. I might get those invested quickly, and I might invest the bonds last. So kind of an opposite approach. But in a normal market environment where stocks might be trading higher or closely to fully valued, I might invest the bonds first, get those invested today, because historically bonds don't move a whole lot. I know 2022 is challenging that narrative, but I might invest the safe assets first, and I might invest the more risky assets last. So the risk-based approach is a little more nuanced. In a normal market environment, or even in a bull market, I would invest the bonds first. In a bear market or a bad market environment, I might flip that and invest the stocks first, or invest the whole portfolio more quickly than I would if it was a normal market environment. So I hope you enjoy this. I'll briefly recap. There's the all-in approach. If you have a longer runway, if you're younger, if you have time on your side, find a portfolio that fits you, invest it all today, and move on with your life. Don't overthink it. If you want to smooth out the ebbs and flows of the market and maximize your savings rate, dollar cost average over time. You don't care what the market does. You're investing in down markets. You're investing in up markets. Over time, your entry point, the underlying movement of your portfolio is going to be smoothed out based on a dollar cost averaging approach. A strategic approach, you can target sectors that are out of favor. So this is out of date. Like if I'm looking at this and I'm interested, and this actually worked out nicely. So let's look. June of 2020, energy stocks were getting beaten up. So if you had cash and you said financials and energy are getting crushed, fast forward to 2022, you made a brilliant trade. Okay. So that's kind of the benefits of the risk-based approach. You're investing in out of favor asset classes today, which will eventually have their day in the sun. It could be a year, it could be 10 years, but eventually markets move in cycles. And then the last approach, again, is a little more nuanced, a little more complex. This is something that we do for our clients, is the risk-based approach. So targeting asset classes that are beaten down and getting them invested more quickly, or targeting assets that are safe, like bonds, first during a more normal market environment, with the goal of getting invested over a set period of time. In my example, I use 30 to 60 days. So I hope this is useful for you. I hope it weaves in some empirical evidence, kind of overlapping the emotional side of investing, and hopefully you can find something that works for you. Thanks for tuning in. Take care. Bye-bye.